Good evening and welcome to our winter term money webinar series by the Institute of International Monetary Research in collaboration with the Vinson Center for the Public Understanding of Economics and Entrepreneurship at the University of Buckingham. I am Damian Pudner, Director of the IIMR, and today we are very fortunate to be hosting Professor Lawrence H. White. Lawrence is Professor of Economics at George Mason University. He is known for his work on market-based monetary systems. His Better Money, Gold, Fiat, or Bitcoin was published in 2023. He is also the author of The Clash of Economic Ideas in 2012, The Theory of Monetary Institutions in 1999, Free Banking in Britain, second edition 1995, and Competition and Currency 1989. Professor White's research has appeared in the American Economic Review, the Journal of Economic Literature, the Economic History Review, and other leading economics journals. Furthermore, his popular writings have appeared in the Wall Street Journal and elsewhere. Professor White holds a BA from Harvard University and a PhD in economics from the University of California, Los Angeles. In May 2023, he gave the keynote address at the annual Swiss National Bank Conference on Crypto Assets and Financial Innovation. He is also a monetary policy advisor to the Layer 1 blockchain project, Prosaga, and is an advisor to the non-profit stablecoin rating agency, Bluechip.
Thank you, Damian. Let me share my screen so I can have some pictures. You don't have to just look at my face. So the question before us, should the state or the market provide digital payment media? These are interesting times for those of us who study money and banking and payments, because a lot of new products are on the market. And so far it's been private sector products. Most of us are familiar with money transfer apps like Venmo and Zelle, and in Sweden, Swish, in India, Paytm, in China, Alipay. And these enable us to make transfers through the banking system of pounds or euros or dollars very conveniently using laptops or phones. We've also seen since 2009 the introduction of cryptocurrencies. The most famous, Bitcoin, reached a nominal record high today. Bitcoin is its own unit, so it's denominated in Bitcoin. But we've also in recent years seen the introduction of stable coins, which are cryptocurrencies denominated in and redeemable for fiat monies or gold. So we have US dollar tether, USDC, DAI are some of the leading stable coins. And the point of all these products, and especially of the crypto products, is that compared to our legacy payment system that runs through banks and central banks, these methods are faster. So they settle in minutes, they don't take days. They're cheaper for many purposes, certainly cheaper than wiring money. And they're more resistant to surveillance and censorship. So that's great. I use these products. I'm sure you all do. But in the last few years, we've seen proposals that central banks should get in on this new payments technology, that they should provide what's called a central bank digital currency. There are two models. One can be called the coin model. It's the idea that a central bank should issue its own stable coin denominated in its own fiat unit. And the second model is that it's an account model where anybody, any household, any business firm can have a checking account, a transferable deposit account on the books of the central bank. That's the more popular model. That's the one I'm going to focus on. But notice that currency is something of a misnomer in that case, because it's not a hand-to-hand medium that circulates outside the banking system the way what we traditionally call currency does. So many central banks are jumping on this bandwagon. They're either conducting trials or they're planning trials of such systems. As I said, mostly the account model. These are not new monetary units. They don't change the monetary standard, and so they don't do anything to reduce inflation. They're under the control of central banks the way the ordinary money is today. They're another way to hold and transfer dollars or pounds sterling or other fiat money units. Why are people proposing that central banks should get into this business? What's the rationale for the public sector entering retail payments? So Vera Smith famously in the 1930s published a book entitled The Rationale of Central Banking. I'm asking, what's the rationale of central bank digital currency? Some proponents, when you ask them that question, don't really offer a rationale so much as, well, it's not such a change from our precedents. We've seen things like it before. After all, central banks already provide paper currency, which is true, but not exclusively. Commercial banks, when they're allowed to, as they are still allowed to in a few places, Scotland, Northern Ireland, Hong Kong, Macau, issue paper currency. Historically, in the 19th century, they were the providers. Commercial banks were the providers of paper currency until central banks took it over through imposing legal restrictions on private providers. As I mentioned, CBDC account balances aren't really currency, so this precedent doesn't really apply. Second precedent, the central bank already provides wholesale digital payments. That's true. The central bank is the banker's bank. It provides a mechanism for commercial banks to pay one another, but that's a very different business. Central bank digital currency would be a retail business, a retail payment mechanism. Every household, every business firm could have an account on the central bank's balance sheet. That's a very different proposition from a limited number of banks having them. The financial historian Harold James, in an op-ed a few years ago, wrote that money, quote, has almost always been an expression of sovereignty, and private currencies have been very rare. Of course, it's simply not true that private currencies have been very rare. If you count commercial banknotes, they were the majority of money in the 19th century. But to say that money has almost always been an expression of sovereignty is not really to recommend it, because sovereigns have not done a very good job of managing money. So let's get to some actual rationales. And a few years ago, I shared a platform with the economist Nouriel Roubini. And Roubini was a very strong advocate of account-based central bank digital currency. And here's the argument he made. By allowing any individual to make transactions through the central bank, CBDCs would alleviate the need for cash, traditional bank accounts, and even digital payment services. And he had in mind things like Venmo. Now, to say alleviate the need for makes it sound like cash and traditional bank accounts are bad things. But people like cash, at least for some transactions. For some transactions, cash is quicker, it's cheaper, it doesn't require any hardware. You can make transactions offline, right? You don't need any connection to the internet. And yet these are final transactions, unlike handing over a paper check, with the transaction not being final until the check is cleared and settled. A currency transaction is immediately final. And these transactions with cash take place outside what you might call the financial panopticon. They're not in the payments, in the bank clearing system, so the bank isn't even aware of them. And anybody who peers into the bank's balance sheet is not aware of them. So that's one reason to be concerned with Roubini's recommendation. If we don't want to do away with cash, then we need to be concerned about central bank digital currency being a means by which cash is removed, paper currency. The second cause for concern is that the public sector is really not known for the efficient provision of services, and I'll say more about that in a minute. And the private sector has traditionally been the system, the competitive system by which we allocate, or the system allocates scarce loanable funds, decides who is worthy of borrowing money, who's creditworthy. And traditional bank accounts, which Rubini wants to alleviate the need for, traditional bank accounts are the main source of lending, especially to small and medium-sized business enterprises. So if all the check accounts move from commercial banks to the central bank, so does the lending they fund. Now, the central bank is involved in deciding who gets loans, and I think we should be concerned about that. I'll come back to that point as well. Rubini continued that here are the benefits. Central banks would be in a much better position to control credit bubbles, to stop bank runs, to prevent maturity mismatches, and to regulate risky credit and lending decisions by private banks. Now, these are all suggestions that central bank digital currency will allow tighter control of commercial banks, less freedom for commercial banks to make loan decisions. It isn't necessary for a central bank digital currency that the central bank make all the loan decisions. Some advocates of CBDC say, no, that's just on the liability side of the central bank's ledger. On the asset side, they don't have to make the loans themselves. We want to preserve competition in finance. They will loan the money back to the commercial banks. So the commercial banks that are no longer gathering so many deposits, where are they going to get funds to lend? The central bank will lend funds back to them that they've collected by collecting all the deposits. But even if they do, the central banks do lend the money back to the commercial bank, it's likely that these loans, these recycling of the money, is going to come with strings attached. And of course, Rubini wants it to come with strings attached. He wants the central bank to, as he says, prevent maturity mismatches, that is borrowing short and lending long. And he wants the central bank to regulate risky credit lending decisions. Right, so what this suggests is that retail banks that do borrow from the central bank are going to be compelled to lend where the government tells them to lend. It's going to politicize the allocation of credit in the economy, which, unlike Rubini, I don't think is a good thing. Let's keep some basics in mind. We've been relying on private commercial banks to provide money for centuries, and they've provided trusted money. People have trusted them and had a good experience with them where the banking system has not been weakened by inappropriate or unwise legislation, legal restrictions. Right? So the kind of money banks issue are checking deposits and banknotes where and when that's been allowed. So money is not what economists call a public good. Often the rationale people offer for having the government provide a good or a service is that it's a public good. But a public good means it has certain technical characteristics that make it difficult to provide on a user pays basis. And those characteristics are non-rivalness in consumption makes it difficult to provide on user pays. Non-rivalness means if you provide it to anyone, it showers down on everyone. Without one person's use of it excluding anybody else's use of it, you and I can both enjoy, let's say, repairing a hole in the ozone layer without my enjoyment interfering with yours. Money balances, though, are a private good. They exhibit rivalness in consumption. The money I use is money that you can't use. And they exhibit excludability in supply. I can stop you from writing checks on my bank account. So those, like, I don't know, chocolate ice cream are like loaves of bread. it can be provided on a user pays basis. So there's no reason to think that the market is going to fail to provide this good in a tolerably efficient way. There are no public good reasons to suspect that. So some have suggested that the payment system is a public good, but it just doesn't meet these criteria. They either don't understand public goods theory or they're using the term public good in some other way. But for an economist to say that there's a public good, you have to ask, where's the market failure, or where are the Pareto relevant externalities? Where are the benefits or costs that are not being properly priced? I've done a fair amount of work over my career on the history of private money, and the private sector has been successful at providing money, and not just bank deposits and banknotes, but even gold and silver coins. So I had a paper a couple of years ago in the Economic History Review on the experience with private gold mints in the gold rush areas of the United States in the 19th century. And there were a couple dozen of these private mints. And the ones that were honestly and competently run survived and provided high quality products. There were a few that were either incompetent or dishonestly run, but they didn't survive. They did not dominate the industry. So it was not a chronic problem. It was a self-curing problem because people found out about bad coins and rejected them. Since at least 1650, when the goldsmith bankers in London began to offer banknotes as well as interest-bearing checking accounts, banknotes quickly became more popular than carrying coins around for peer-to-peer transactions. And so the majority of bank liabilities in the 19th century, both in the UK and in the US, were banknotes. Banknotes were greater volume than even checking accounts. Checking accounts were pretty much a business-to-business system, but ordinary people got paid by getting an envelope of banknotes. We can go back farther to the emergence of modern banking, 1200 AD, thereabouts. And what have banks developed? They've developed easier ways to transfer deposits, paper checks, giro orders, wiring money through telegraphs. And of course, in more recent years, debit cards, online banking, online bill paying, phone payment apps. And today, the private digital currencies like PayPal, Venmo, Zelle, Alipay, WeChat Pay in China, Paytm in India, the M-Pesa system in East Africa, which is a cell phone payment system, and so on. And as I mentioned, Bitcoin and stablecoins. So a lot of innovation in the private sector. But so given the absence of any obvious public good or externality problem, we need to ask, because we can't take it for granted, how would CBDCs improve consumer welfare? Why would we want a central bank doing this instead of Venmo? Well, some of the proponents, I think, fall prey to what Mingardi and McCloskey have called the myth of the entrepreneurial state. It's a myth because we really shouldn't expect innovation or efficiency from public sector employees who have little skin in the game. We really shouldn't expect good retail service from a government agency that, one, doesn't have any experience in providing it, and two, doesn't have much to lose by doing a poor job. I'll give some examples in a minute. So if we want an efficient payment system, if we want a system that does best, that optimizes from the point of view of households and business firms, the people who use the payment system, as opposed to from the point of view of social planners or would-be social planners, what we want is a system that captures all the potential gains from voluntary trade, a system that provides whatever mechanisms people are willing to pay for, which is not something we should expect a top-down designer to be able to figure out, because we rely on competition to figure that out. Different entrepreneurs have different conceptions of what would appeal to customers, and then they test those conceptions in the market, and bad projects are weeded out and better projects prosper. Institutions that are imposed involuntarily by restricting options to do anything else, you can't say that's an improvement, because it hasn't passed the test of people voluntarily adopting it. And when it comes to doing the business of providing retail payments, some proponents of central bank digital currency just assume that central banks can provide it as efficiently or more efficiently than commercial banks and financial technology firms. And in some cases, they're just saying, let's put that issue aside so we can focus on some other feature. But we shouldn't take that assumption as a fact about the world. If we're asking the question, do we want central bank digital currency? We can't just assume that it's going to be run at minimum cost. I think that's pretty much wishful thinking. So here are some cautionary tales about state-owned enterprises. The US postal system launched a service called eCom in the early days of email, where if you didn't have a personal computer, you could have someone send you an email to your postal address, and they would print it out and deliver it to your house like ordinary mail. They lost millions of dollars on this scheme. Nobody used it. They invested a lot in the hardware and the networking, and nobody used it. They finally killed it after a few years. A similar experience in Ecuador, which was one of the first countries to introduce a state-issued electronic currency. The dinero electrónico was a cell phone payment system run by the government of Ecuador, and they spent a lot of money to launch it, and nobody wanted it. They did a poor job marketing it. It was technically not all that convenient to use. So they lost a lot of money, and they eventually pulled the plug on it after 3 or 4 years. Outside of the financial system, we have examples like Petro-Canada, which has since been privatized, but which was a state-owned oil company in Canada. And reports indicate that they had about twice the staff that they needed to deliver services. And so it was a chronic money loser. And they, as I said, finally privatized it. More recently in Wales, they've had some bad experience with a development bank of Wales, and connected with that, a life science investment fund. So the Welsh government was trying to pick winners, decide who to lend money to, and the people they lent money to failed and couldn't pay them back. So we want that kind of activity in the private sector where people bear a cost for squandering money. We don't want it in the public sector. So I have 4 main objections to central bank digital currency. I've already hinted at them, but let me spell them out more explicitly. First, central bank digital currency would be inefficient at retail payments. That is, it would operate at higher cost than private systems, and it would be less customized to the services that people really want. And remember, central banks don't have any experience in retail payments. There's no reason to think they would be good at it. They have no track record of being good or bad at it. Some proponents have talked about offering accounts for all, meaning not just commercial banks, but every household, every business can have an account on the books of the central bank. To provide the same kind of service to households that commercial banks provide, the central bank would need an army of tellers the way the banking system needs. In the United States, it would be 400,000 tellers. In Britain, probably something proportional. And you're replacing tellers and phone operators with government employees. No reason to think they would be paid less or that they would do the job more effectively. Secondly, is the problem of who gets to make the lending decisions. If the central bank is gathering all the households' funds, or at least the household funds that would otherwise be in checking accounts at commercial banks. So in principle, as I said, they could just send the money back to the banking system, say auction it off to the highest bidding commercial banks. And in principle, the commercial banks could then make the ordinary credit allocation decisions they make today, trying to find creditworthy borrowers. But in practice, I think it's pretty clear that it's not going to be no strings attached. Central banks are going to be pressured by legislatures to extract from commercial banks that get the money what are sometimes called socially proactive commitments. That is, they're going to have to follow lending mandates. They're not going to be allowed to just allocate the money to where it's the most productive. There are going to be social objectives mixed in. So it's going to politicize the allocation of credit. So it could take the form, well, there's pressure on central banks now not to discourage commercial banks from lending to, say, fossil fuel companies. So it could take the form of if a bank gets money from the central bank, it's not allowed to lend to disfavored industries. Or it could take the form of they have to make a certain amount of loans to socially disadvantaged groups. And we had an example of that in the United States. We have these two giant mortgage providers, Fannie Mae and Freddie Mac, that are government sponsored. They're nominally private, but Congress imposed on them quotas where they had to make, first it was 30% and later it was more than 50% of their mortgage loans had to go to households with below median income. And that's not an efficient allocation of resources if the creditworthy borrowers are elsewhere. So in graphic form, here's the choice. Our savings or our checking account dollars either go to multiple commercial banks who compete with one another and whose balance sheets have business loans as the main asset, or the money can go to the central bank whose main assets are government bonds and whatever other favored recipients of funds they've decided to allocate credit to. So the Federal Reserve System is holding trillions of dollars in mortgage-backed securities under the theory that it's a good thing to encourage home ownership. But encouraging home ownership comes at the expense of making those funds available elsewhere in the economy. So if by decree a bigger share of funds is going to home building, then less is going to other places where it's promising better returns. You wouldn't need a mandate to tell banks to lend to where the returns are the highest. But if you want them to lend to places that particular uses, regardless of the lower returns, then you put in a mandate. And so that's been an area where central banks have begun to interfere in the allocation of credit. And central bank digital currency would encourage that, would enable that to an even greater extent. Third, and this is a dramatic picture, I realize, and a dramatic statement, central bank digital currency is a financial panopticon. The panopticon was a prison design that Jeremy Bentham came up with, where the jailer from one point can look into every cell. central bank digital currency is a financial panopticon because the central bank can now look into everybody's bank accounts in real time. It's on the balance sheet of the Fed. So they know what is in your account and they know where you've transferred it to. They know what you're spending on and they know where you're receiving your income from. And that's all available to them in real time. So that has to give us some pause. It's a threat to financial privacy. So I think it's a serious question whether we can preserve privacy in a system where all the accounts are on the government's ledger. And just to take an extreme case to make the point, China's central bank digital currency system, sometimes called DCEP for digital currency electronic payment, is clearly designed for surveillance. That's the purpose of it. And everyone is being forced into this system so that I mentioned Alipay earlier. The Chinese government is suppressing Alipay and its rival WeChat Pay in order to force people into the government bank system. All the commercial banks in China are government owned. There are 4 big ones. So these accounts are available for surveillance 24/7. One observer described it as unconstrained data collection and the creation of powerful new tools for social control and economic coercion. Right. So the Chinese Communist Party is pushing a social credit system where whether you get to spend on what you want to spend on depends on whether you're judged to be a good citizen, whether you have enough social credit. So if you're suspect, then when you go to buy a train ticket, you may find, whoop, that transaction won't go through because you're not entitled to buy a train ticket. You don't have enough social credit. Right? So that's the sort of scary scenario. And you would think I wouldn't have to say that we don't want to follow that example, but I hear advocates of CBDC sometimes at least saying, oh, China's getting out ahead of us in technology. We need to keep up with them. No, it's a surveillance technology. We don't want to keep up with them in surveillance technology. One way to ask the question of how much privacy will be allowed under a central bank digital currency system is to ask, will it allow anonymous payments, even to the extent that they are allowed today when using cash? So in the US, if you make a cash payment of $10,000 or more, the recipient is required to report it to the US Treasury. And if you make 2 payments of $5,000, that also has to be reported. I'm not sure about the reporting requirements in the UK, but at least in the US and UK, it's not illegal to make large cash payments. In much of Europe, it is illegal. There's a limit. You can't spend more than 5,000 euros, let's say. I think that's the limit in France, in cash. You're just not allowed to. Well, that's impinging on your financial privacy because now you have to make that in a way that's more easily traceable. So privacy is not completely secure today because banks can be forced to give their records over to the government when it comes and asks for them. But privacy stands a better chance in a system where accounts are held by private banks and their data is protected from snooping in real time, at least. Now, in principle, a CBDC could be designed to preserve privacy. It's just unlikely in practice. So I mentioned the coin model. For the coin model to protect privacy, it would have to be that the central bank enables people to use unhosted, so-called, or peer-to-peer digital currency wallets that allow them to make transfers without it showing up in any record available to the central bank. So a system without reports. Would they allow that? Well, the US Treasury, at least, through its Financial Crimes Enforcement Network, is already proposing to ban self-hosted crypto wallets on the grounds that they're too similar to an anonymous bank account and, in other words, allow too much privacy. So would they allow that much privacy in bank transfers seems unlikely. And what bothers treasuries the most about this token model or coin model of CBDC is that they fear it enables tax evasion. There's a link between proposals for CBDC and what's called the war on cash. Up to this point, I've assumed that central bank digital currency would be voluntary. You don't have to open an account at the central bank if you don't want to. You can still have the option of having a bank account or dealing in cash if you want to. But some proposals for CBDC are linked to eliminating paper currency, which you might call analog currency by contrast to digital currency. And why do they want to do that? They want to combat black market trades. They want to combat tax evasion. And in macroeconomics, some want to enable a negative interest rate policy. They say, look, people can flee into cash when interest rates get to zero, which stops interest rates from going below zero on bank accounts or on bonds, because people always have the option of switching to cash, which has a zero return. They're not going to accept negative. So we need to abolish cash in order to enable a negative interest rate policy when we think that's what the central bank needs to do to fight a recession. I don't think you need negative interest rates to fight a recession. You still have the option of expanding the money supply. It's a mistake to think that monetary policy has to only or can only work through manipulating interest rates by using an interest rate instrument. And it's clear that forcing people to accept negative interest rates is not making customers better off. It's not making the public better off. So it's not a Pareto improvement. The objective of suppressing black market trades raises a kind of civil liberties issue. Do we want to suppress black market trades? I mean, of course, we want to suppress murder for hire and extortion and things like that that involve violence and victims. But a lot of what's called black market activity are victimless crimes, trades for illicit substances or trade in illicit services. And these trades, we might, personally disapprove of them or turn our nose up at them. But from the point of view of people participating in them, they are improvements in well-being. They're voluntarily making these trades, so they must think that it makes them better off. If we crush those markets, then we impose welfare losses on people whose transactions are crushed. And my last objection is that central bank digital currency stifles dynamic innovation in the economy. So the efficiency losses I talked about earlier are kind of static efficiency losses. But I mentioned the history of private sector innovations in payments. And if all the payment system is in government hands, it's hard to expect much improvement from now on. Hayek in the 60s wrote a wonderful essay on competition as a discovery procedure. It's through competition, not through collaboration or not through top-down design, that we gradually increase our efficiency over time. That is, provide goods and services that better meet the wants of the public. And in his denationalization of money, he applied this lesson to competition in payments. As competition usually does, it will lead to the discovery of yet unknown possibilities in currency. I'm interpreting that as possibilities in payments, either through the existing banking system or through parallel systems like stablecoins or Bitcoin. So we don't want to rule that out. We want to find out, let the market tell us which of those systems actually meet people's wants. All right, I will stop there and take questions in case I've said anything controversial.
You've done such a great job there explaining everything. You've not really left much room for questions, but I do have a few. Gabriel Stein thanks you for a fascinating talk, and he agrees with very much with what you've said. he says there is one further argument against central bank digital currencies that you didn't bring up, and maybe you could consider this and give your thoughts. That is the possibility that a central bank digital currency may begin to diverge in value from cash and commercial bank accounts. This is certainly likely if the central bank digital currency cannot be used for everything.
The central bank digital currency systems that I've seen discussed are all based on interchangeability between central bank digital currency and existing central bank liabilities. So you can get dollars for your CBDC dollar. You can get pounds for your CBDC pounds. So it runs on a redeemability system. And that means the value can't diverge from the value of the underlying fiat money. If somehow it floated against the underlying fiat money, then it wouldn't be a central, well, it seems like the central bank wouldn't want that to happen. And they have the means to prevent that from happening by simply redeeming the central bank digital currency. If people want to get out of it, rather than having the value drop, they shrink the quantity by redeeming it for the underlying fiat money. And rather than having the value rise above par, they will issue as much of it as people want to hold by converting their other forms of fiat money into central bank digital currency. So I don't see that divergence being a problem.
Okay, thank you for that. Several people have raised concerns over the potential for the weaponization of CBDCs. I know that Professor Kevin Dowd at Durham University in his recent paper mentioned this weaponization and the ability for central banks to limit where and what degree people can use this new form of money. Do you have any comment on that?
Yeah, so I thought I was being harsh enough when I called it a financial panopticon, but actually there's more. It can get worse than that. So in token form, if it were introduced in a kind of token form where you have a wallet in which the money resides, those tokens could be programmed. So they wouldn't even have to be watching you. It's already built in that you can't spend them on things that are not approved. Or, flags are raised if you try to spend them on uses that are not approved. So I think that's what Kevin means when he talks about weaponization. They can be used to more effectively enforce restrictions on people's transactions. And that could also be true of account-based CBDCs. There could be some filter through which your payment has to go, and if it's for an unapproved purpose, it gets flagged. So only certain transactions are whitelisted and others are stopped. So that is certainly a danger.
Okay. I'm just looking through the questions here. Say a lot of them have been answered already. Central banks have been looking at this and talking about the potential for, CBDCs for a number of years now. Do you think it's inevitable that we actually get a central bank digital currency, or will they always remain this hypothetical concept?
I don't think it's inevitable. I mean, we've already seen them launched in a few places. I mentioned Ecuador, which had a failed experiment in CBDC. Nigeria has an electronic naira. The Bahamas has an electronic or digital sand dollar. These are central bank digital currencies, but they're voluntary. Their adoption is not enforced, is not required, and nobody's adopting them. So they're not at all popular with the public. And the reason in Ecuador that they failed is that people didn't trust the government to actually make good on its promise. And Ecuador, of course, is a dollarized country, so they were issuing claims to dollars. And the Ecuadorian government had defaulted on its bonds, which means not too much of a stretch to imagine they might default on their dollar obligations to the holders of these CBDCs. Now, a central bank that denominates the CBDC in its own currency that they can print up unlimitedly wouldn't have that problem of default, but they would have the problem of issuing a lot of money to buy back unwanted CBDCs. That would be inflationary. So there's an inflation risk, even as there is with any unit of fiat money, even if there's not a default risk. So I expect some countries some larger, more developed countries to launch CBDCs, but it remains to be seen whether the public will go for it. So in Sweden, cash is used very little. Just on a voluntary basis, there isn't that much use of cash. But they have a private bank coordinated not CBDC, digital currency system, interbank digital currency system called Swish. I don't see any reason people would want to abandon Swiss for a liability directly issued by the Bank of Sweden. Unless there were some advantage offered that isn't available through the bank accounts. One of the selling points I haven't mentioned in the US is the idea that the CBDC would settle faster than check transfers, even electronic check transfers. Well, you can get faster settlement without a CBDC if the Fed would just speed up its own settlement system. Incredibly, they don't run 24/7. They're closed overnight and they're closed on weekends and holidays. And so it can take 3 days for your check to settle. They could speed that up, and they have promised to launch a system called Fed Now, which will speed that up. CBDC isn't needed for the purposes of speeding up settlement.
Right, right.
So the countries that go first will see whether it actually flies, whether it's popular. And if it's not, then other countries won't follow. So it's actually advantageous to go last in this case. There's no hurry. See how it goes in other countries. See whether it's worth investing in this system. It's going to be expensive to set up.
I was just going to say one final question, and it kind of leads on nicely from that. Who, in your opinion, do you think will go first? Will it be China? Will it be a Western country?
Well, China is rolling out its CBDC, but it's compulsory. So it's not really a test of whether it's making the public better off. And since it's designed for surveillance, I think it's clearly not making the public better off. So we see sort of courageous Chinese who don't want to be surveilled, making transactions underground using Bitcoin or some other cryptocurrency method. But they have to stay underground. It's dangerous to evade the system that's being imposed on you. So yes, China, but who will go first in the West and in a system that's voluntary? I guess I'd have to look and see who's farthest along at launching. It might be Sweden. I'm not sure.
Right, right. Larry, thank you again. We're going to wrap it up here. I know it's quite late. You know, you've been very generous with your time. So we do thank you on behalf of the Institute, and I'm sure everybody's had a wonderful seminar. Thank you very much. I wish you all a good night.
Thank you.